A few months ago, I posted to LinkedIn something like, how come IUL is just as complex as a derivative with floors, caps, call options, and participation rates, yet it's not regulated by FINRA? Like many of my posts, it sparked quite an outrage. And if you see some of these grifters on TikTok claiming that IUL is better than a 401k, it has upside potential with downside protection, a can't lose money asset, privatized banking, infinite banking, all of the crap that people are saying about it, you'll know why the outrage is well deserved. But the good news is that we're going to bring some transparency to it. And today I have one of the good insurance guys, one of the most knowledgeable people in the field, Bobby Samuelson, here with me to shed some light on IUL. Bobby is the president of Life Innovators and the executive editor of the Life Product Review. Hey, Bobby, thanks for being here.
Thanks for having me on. I'm excited to talk about Index 2L. So should be good. And this topic needs transparency. So yeah, I'm sure we'll have a great conversation about it.
Awesome. So, Bobby, let's just start with a real quick definition. What is IUL?
Yeah, so let's actually take one step back and say, what is universal life? Because I think a lot of times we kind of get wrapped up in the different variations of universal life. And I think it's good to start at the beginning and say, okay, what actually is this product? And then I'll make the different variations make more sense. So universal life is a very simple product. I think if you're a financial advisor and you've seen it out in the marketplace, it probably doesn't look simple, but the actual math is very simple. And the way it works is you put a premium in, and the premiums are totally flexible. Client can pay really whatever they want to pay, down to some sort of a minimum or all the way up to the tax maximums. Policy charges come out every month. Whatever's left over earns an interest credit, and then that creates your cash value. And every month, this cycle repeats. You can pay premiums or not. Policy charges are still coming out. Whatever's left over earns interest, and then you have this liquid cash value available inside the product. And all an illustration is then, which is what financial advisors typically see, is just a forward projection of this monthly cycle recurring over and over and over again. So the way that universal life policies are typically kind of differentiated is by how that interest is being credited on the cash value. And so you have sort of traditional fixed universal life, which basically the carrier declares a crediting rate on that policy. Then you have variable universal life, where you take the money and you actually invest it into insurance dedicated mutual funds, and you get whatever investment returns you get. Policy charges are still deducted, but the returns are kind of controlled by the funds themselves, the investments that you're making. And then the last piece, which is the one we're talking about today, is Index UL, where the carrier effectively takes the universal life product, fixed UL, and instead of paying a crediting rate, they take those earnings off their general account. They go out and they buy call options, and the call options provide index-linked exposure in terms of your crediting rate.
Hold on a second. I'm sorry. Let's just go back over what a call option is, just because I'm so sorry for this, Bobby. Okay, so let's go back to the part where you said an IUL is like a fixed UL, and then let's go back.
Yeah. Well, so I'm going to explain it later. And that was where I was going to go. Is I was going to say, you may not know what a call option is. Here's kind of what it does. Here's the index credit, and that's how it does it. But yeah, I can go back to that. No, that's no problem.
Okay. Let's just start with that point.
Yeah. So with a fixed universal life product, you get a crediting rate declared by the insurance company, and they're supporting that with their general account assets. With a variable universal life policy, the carrier takes the money, they invest it in, or the carrier, with a variable universal life policy, you invest directly into funds, mutual funds, insurance dedicated mutual funds that are held in a separate account. And so that's the investment return is whatever it is. With Index UL, the carrier basically says, all right, instead of paying the crediting rate to the policyholder like we do in a fixed universal life policy, we're actually going to take that crediting rate. We're going to go out and we're going to buy call options. And all a call option is exposure to the performance of an external index. And so by buying these call options, we now can give these index-linked credits to the policyholder instead of the crediting rate in the universal life policy. So one of the key things to know right off the bat is that universal life and IUL are essentially the same product. The only difference is that with universal life, the carrier gives you the crediting rate. In index universal life, the carrier takes the crediting rate, goes to an investment bank, buys call options, and then that gives the client index-linked exposure. So the fundamental math, the fundamental mechanics, all the underlying financials are identical, except for that last step where the carrier takes the crediting rate, gives it to the investment bank, buys options, and the options provide the index-linked exposure. Now, that's also the part where it gets really complicated, because I think when you look at all the stories about IUL, like what this thing does, how it works, mentioned it, downside protection, upside potential, equity-like returns, better than a 401k. Nobody would say all that about just a regular old universal life policy. But the only difference between universal life and indexed UL is that options piece, that very last step. And what that does is create this kind of illusion and this veneer that IUL is something fundamentally different, that it's an equity product, that it does all these magical things. And the reality is all it is really just a universal life policy where the carrier, again, takes the crediting rate, instead of giving it to the policyholder, gives it to an investment bank to provide index-linked exposure. And that's it. So fundamentally, that's what indexed UL is. Now, there's lots of different discussions about how it's illustrated and how it's used and how it's marketed. But in terms of the mechanical, structural construct of the product, that is what that product is.
Why is it dangerous from a marketing perspective?
So it isn't, structurally, it isn't dangerous, right? I mean, it is just the same as a fixed life insurance policy.
Well, okay, let's just go over that actually. What is the danger with any investment insurance product? Any cash value insurance product? What is the danger there?
Yeah, the danger is policy lapse. And the power of a whole life policy is that it's a guaranteed premium with a guaranteed death benefit, guaranteed cash values. It can't ever lapse. So there is really kind of no danger in a typical whole life product in terms of policy lapse. With universal life, because the premiums are flexible, you can have a policy lapse. You can have a situation where the policy charges increase or the credits aren't good enough and the cash value starts to decline, and you end up lapsing the policy, not getting what you thought you were going to get.
If you can't pay the premiums yourself.
Correct. Yeah, then you don't have enough cash to cover the policy charges. And again, that monthly cycle repeats every month. There's always a charge to be paid. And if there's not enough account value, the policy lapses.
What does somebody do in that case? Like, let's say that happens. Let's say that the S&P has like last year had a bad year and it's not crediting enough to the cash account. And I have these flexible premiums, but my premium had gone up because the cost of insurance had gone up. And so the company raised the premium rate on me. Yeah.
So
what do I do?
They actually wouldn't raise the premium. I think this is one of the misconceptions here is you would not, as a policyholder, necessarily know that you need to pay more premiums. You would need to go through an annual review process with the agent to have them tell you, hey, you've got a problem, because the carrier just says, oh, you planned to pay XYZ premium. That's all we're going to bill you for, unless you tell us to bill you something different. And so to your point, last year, when the market goes down, you get a 0% credit in an IUL, let's say, policy charges still come out. The cash value is going to decline that year. So you mentioned earlier that one of the marketing pitches for IUL is you can't lose money. That is absolutely not the case. You are guaranteed to lose money every time the market goes down. You get a 0% credit. Policy charges still come out of the account value. The account value will decline. You will lose money that year. And the amount of money you lose is going to be exactly equal to the amount of policy charges coming out of the contract.
Or it might not even be when the market declines, but just if the market has a year where my crediting rate does not overcome the policy charges.
Bingo. That is correct. I say you're guaranteed to lose money when you have a 0% because you know that it can't overcome it. But to your point, there's this gray area where you might actually get a flat year or a negative year in terms of cash value performance if the credit isn't big enough. If it's a 1% credit or a 2% credit and your policy charges are greater than that. So that kind of leads to the other risk, which is, that's potential policy lapse. But the question of sort of disappointment is a different question. So when you look at how whole life in a lot of ways and IUL especially are marketed, they're marketed with very high illustrated rates, very high performance expectations. And that's where things get dangerous. It's not that policy lapse is the biggest risk. The problem is that clients go in, and you and I have seen crazy stuff. People borrowing money against their house, taking money out of 401ks to buy IUL under the idea that this long-term performance will be there. For them, their worst case scenario is probably not a policy lapse because they're overfunding the contracts, and the idea that the charges will eat up the value is pretty remote. The problem for them is that they went into this deal thinking they were going to earn 6, 7, 8%, and they actually end up earning 3, 4, 5%. and that is that now their whole financial plan is wrecked because
Retirement shortfall.
yeah, they have a shortfall. And so this kind of leads to the real issue, which is the danger. Back to your question with IUL is not the policy structure. The policy structure is sound. The policy structure works. The policy structure will work any way you want it to, like a universal life policy would. The problem, the danger, is on the illustrations and the way that these things are being illustrated and the performance being shown to clients. That is where the issues are, and that's again like. If you think about all the ways that these products are being marketed on TikTok and whatever else, it all relates back ultimately to this aggressive illustrated performance being shown to clients, which creates aggressive expectations of future performance that they may not get. And if they don't get it, to your point, they'll have a shortfall. They won't get what they thought they were going to get. If they've applied leverage, it won't beat the leverage. That's where the issue is.
About the leverage, can you just talk about that? Because I think that's not well understood by financial.
Yeah, so there's really kind of two types of leverage that people typically illustrate applying to these contracts. The simplest one is simply policy loans. And so in every IUL out there, the primary illustration kind of that you see is when the client takes a policy loan, they are effectively collateralizing the cash value. So think about taking out a home equity line on your house. It's the same concept. With a home equity line, you collateralize your house, and then the house hopefully appreciates irrespective of the fact that it has collateral against it. Same deal with an IUL. You're collateralizing your cash value. You're taking that loan. And what the illustration assumes is that if you take a loan out and the carrier charges you, let's say 5% to take that loan out, they show that the illustrated performance on that loan that you've taken out is actually 6 or 7%. It's something higher than the 5% that you've taken out. And so you have this concept, again, to use the HELOC example, if you take a home equity line, and imagine forever taking home equity lines off of your house. That works as long as the house appreciates faster than the interest rate on the HELOC increases. Same problem or same issue shows up in an IUL where you take the loans out, you apply leverage, right? Because now you're borrowing money. You have to beat the loan rate in order to keep this working. And so the illustration looks like it's going to always outperform the loan. You can take money out forever. The policy equity grows even though you're taking money out of it. It's this magical phenomenon where if you look, for example, like take the 4% rule. If you apply the 4% rule, that logic of, okay, I've got, $1 million, I can take 4% every year. If you look at that, if you look at IUL illustrations through the lens of that, most IUL illustrations show 8 to 12% withdrawal rates on a balance because of this arbitrage being illustrated in the contract. And it's a ton of leverage. So back to your question, what happens if you get a bad year? Well, if you don't have any policy loans and you get a bad year, to your point, 0% credit, policy charges come out, your account value will dip by a little bit. But if you have a policy loan, and I see a lot of situations where 95% of the value in the policy has been loaned out through income streams, you have one bad year and that policy lapses because the loan value goes higher than the account value. So boom, you get a policy lapse. And at that moment, the client gets stuck with a phantom income tax bill for all of the gains in the contract that they have pulled out. And all they really need is just 1, maybe 2 years of 0% credits. And that's the leverage I'm talking about, is if it's an unlevered contract, a 0% year just causes your account value to dip. But if you've levered up, you've taken all these policy loans, now you are incredibly sensitive to any variation in performance. And that will cause the policy to potentially lapse. And again, you get stuck with a phantom income tax bill. So that's the main type of leverage that I see on Index 2L illustrations. And all the TikTok stuff, all the, use IUL for retirement income, all uses this strategy. That's the core of that strategy, is this loan and this arbitrage and this long-term illustrated performance.
Is the loan typically fixed or variable?
Depends. So there are basically 3 types of loans you can take. You can have a fixed rate, which is what I described for simplicity, 5% rate. You can have a variable rate where the rate floats with the Moody's Composite Bond Index. And so that'll move up and down. And in the last year, we've seen obviously a huge increase in those rates being charged as interest rates have come up. And then the third way is that carriers can declare the rate that they charge on the loan. And so they don't directly link it to the Moody's Composite. They don't guarantee it at a certain rate. They just simply set the rate however they want to set it. And they've got to manage their own internal dynamics on what rate they want to use. But they might declare a new loan rate every year, every 6 months, or every 2 years, however they want to do it. It just depends on the company. And by the way, there's no right or wrong answer. All these loan structures have different times where you'd rather be in one versus the other. Personally, I think the declared rate loans are actually the best way to manage a policy in the long run, but there are advantages and disadvantages to all the structures.
Okay, Bobby, so let's just suppose that I'm Mr. or Mrs. Financial Advisor, and let's just even suppose I'm a fee-only advisor. Just for the purpose of simplicity, I do not sell insurance. I don't get compensated for insurance. I can't accept commissions. If someone needs term life, I refer them to the insurance agent down the street. So one of my clients comes in and says, I was at my country club and there was Mr. or Mrs. insurance agent that was putting this insurance policy in front of me. I'm so excited. We could go to Bermuda. Okay. So like, what do I do at that point when I'm sitting here looking at the illustration, Bobby? What do I do? How do I know how do I see through the illustration and dispel this myth?
Yep. So again, I think it all starts with helping the client understand what the product is. And I've talked to, I don't sell insurance. I've never sold insurance. But a lot of people find me on the internet and they call me, clients find me, like end users find me on the internet and they say, hey, I bought this IUL or I'm considering this IUL or any type of policy. What is it? And I always start with the same explanation. Every permanent life insurance policy works the same way. Premiums come in, charges come out, whatever's left over earns interest. That's your cash value. If clients don't understand that, and if advisors don't understand that, the rest of the conversation is extremely difficult, because what that allows you to do then is say, okay, I'm looking at a bunch of numbers on a page. I see that the client puts in $100,000 in the first year and they only have $80,000 of account value. What do I know right off the bat? That there were $20,000 worth of policy charges that came out, because we know the formula: premium in, charges out, interest earned. It's actually probably more than 20,000, right? 22,000 or so, because they've got to earn interest on whatever's left over. So you have to know that's what's going on. That's number one. And then the second thing I'd say is, all right, so knowing that that's how the policy actually works, then we know that there's no magic going on in here. The only thing happening on this illustration is the assumed interest rate is what's driving the long-term performance. And so we need to hone right in on that assumed interest rate assumption. And so on an illustration, you should be able to see exactly what the assumed interest rate is for the future long-term projections that's being used. And that'd be the thing
being what you called the crediting rate.
Correct. Yeah, so crediting rate is universal life. Assumed interest rate is probably a better term for IUL, because the carrier, there's discretion. With a UL, the carrier sets the crediting rate, and that's what you illustrate. You can illustrate less if you want to, but with IUL, there's this maximum AG 49 rate, and you can kind of pick a rate anywhere in between. And maximum AG 49 is meant to be a guardrail, so it's not what the carrier is actually crediting. It's just a way to convert the option strategy essentially into an illustrated rate. It's wildly subjective.
Smoke. Okay, hold on a second.
Yeah.
There's this AG 40
9. Yeah.
AG 49 implied rate.
Yes.
That is not necessarily equal to what that's illustrated.
Correct.
And what is it based on?
Okay, so here's what it's based on. So again, you think back to the logic. This is a universal life and IUL are the same. The only difference is that with a UL, you get the crediting rate, you illustrate the crediting rate. With IUL, the crediting rate goes to by the options, and the options give you exposure to the index.
So let's just say if the index, so this is not by the way, everybody, this is not a direct investment into the index. This is
correct
exposure to the index. So let's say that, and by the way, is it a total return or a price only index?
It's a price. These are almost all price only. Yeah.
Okay. So the S&P price only index.
Yep.
And let's say that it's the S&P does 9% that year.
Yep.
Is the implied crediting rate 9%?
If the cap so the cap is what the carrier sets. So they set the crediting rate for UL. They set the cap for IUL. And the way that they determine the cap, which is the maximum credit you can earn, the way that they set the cap based on index performance, right? The way they set the cap is by taking that crediting rate and buying options. So if options become expensive, the cap must come down.
Options become expensive when it's a volatile market.
Correct.
More
now it's a little
more expensive options, which would mean the cap is lower probably, right? Because the insurance company is going to take their share and the AG 49 rate is going to be lower.
Correct. Correct. So that's the dynamic. So the cap, you would expect the cap to change regularly because option prices change all the time. So the carrier's earnings are pretty stable, but the option prices are always changing. So you'd expect this cap to move around quite a bit. So the way that these things are illustrated is the problem is that how do you illustrate the value of the cap? The carrier sets a 10% cap. Let's say, what's the value of the 10% cap that you should show on the illustration for the next 50 years?
Well, they put 10%. No?
Well, no, they don't. So they say, okay, because you're not going to hit the 10% every year in the S&P. So that would be too high. But the guaranteed minimum is 0. That would be too low. So you basically have two options for how to illustrate it. One option, the logical option, the way that I think every financial advisor who's listening to this would say, oh, this is how this should be illustrated, is you say, well, the fair market value of the 10% cap is what the carrier paid the investment bank to buy the 10% cap. So how much did that option strategy cost to provide the 10% cap? And that is equal to the crediting rate that you would earn on a universal life policy. So, because remember, it's the exact same thing. They're just, instead of paying the policyholder, they're paying the investment bank. So the logical way to illustrate an IUL is to look back to what the carrier spends, the fair market value of the 10% cap. That is not how AG 49 works, because that would make IUL and UL illustrate the same. And all the sexy ways to use IUL in a lot of ways kind of wouldn't work if UL and IUL illustrated the same. You have to, the industry has built a way to illustrate IUL better than UL. And so the simple way they do it is they say, okay, let's say the carrier has declared a 10% cap. Let's go and apply that to historical equity data. So let's say it's a 10% cap on the S&P. We're going to look back to the 1950s to see what the S&P performance was. We're going to apply the 10% cap to historical S&P data. And that is where the illustrated rate comes from. So they are taking historical S&P returns into the calculation to value the 10% cap, and then they project that for the next 50 years. Does that make sense?
Yeah.
And so that's where, so again, back to your question, fee-only advisors looking at an illustration, again, in my mind, two things. This is how the policy works. This is the illustrated rate being used for the ledger. And what I'd say is, if the illustrated rate is at the maximum AG 49 rate, so 5.5%, 6%, 6.5%, whatever it is, you want to see much lower returns to get a feel for what is more realistic.
Okay, Bobby, hold on a second.
Yeah.
I have to go over this point again. Can you just say that differently, because this is very important?
Yeah. So the illustrated rates are totally subjective. There is no long-term history for these products. There is no actual back test, right? It's just a hypothetical back test. And so when you look at that illustration and you see an illustrated rate that's 5.5%, 6%, 6.5%, based on the AG 49 maximum rate, which, like we just talked about, is the cap applied to the historical data, as an advisor, what you should ask for is to see much lower numbers, because that
much
are more
lower numbers than 5.5%, 6%.
Yeah, because you want to see a more realistic picture of long-term performance. Let me put it a different way. This fee-only advisor that we're theorizing here probably has a good view of what they think long-term bond yields are going to be and long-term stock yields are going to be. And the client certainly, as a part of their planning conversation, they probably had a planning conversation to say, hey, what should we assume for your portfolio about long-term future stocks and bonds, right? I mean, I would assume that that's part of the planning conversation. So if you illustrate an IUL with a 10% cap at the maximum AG 49 rate, then you are assuming that past equity returns are going to be identical to future equity returns. And the past S&P total returns, right, which is a driver of the price returns, the total returns are about 12.5% since the mid-1950s.
But that is a total return, not a price return.
Correct. But if you think about it from a planning standpoint, you have a client who's saying, I'm buying a Vanguard mutual fund. The mutual fund is a total return fund. So if I'm an advisor and I've had a planning conversation with a client about their long-term equity assumption, I'm not talking about price returns. I'm talking about total returns.
Right.
Even though the index product is only on price returns.
Right.
So here's the question, right? If you're a financial advisor and you're looking at that 6% illustrated rate in the IUL with a 10% cap, to your point, on a price index, and you're also assuming as a financial advisor long-term equity returns of 6%, if you hold the S&P straight up in total returns, those two assumptions are not the same. The assumption that goes into the 6% rate you see in the IUL illustration is only past equity returns, which are 12.5% total returns. So here's the simple thing. If you're an advisor and you're illustrating out 12.5% for your client's equity portfolio, then you can feel good about the 6% illustrated rate in the IUL. But if you have a lower equity return assumption, 8, 6, 7%, whatever it is, then you cannot illustrate 6% in IUL. You need to illustrate 4 or 3.5 or 2, because fundamentally IUL is a much less risky, much less higher returning asset than holding the equities directly. And so that's the big thing, is telling it for an advisor, is basically just being able to have a conversation with the client and say, look, there's no magic here. And this illustrated rate is what's driving all this future performance. Advisor and client, we decided we were going to use a long-term 6.5, 7% equity return assumption for your planning purposes. This IUL is illustrating at 6. That's based on a 12.5% historical equity return. We need to lower that illustrated rate down to 4 or 3.5 or 4.5. And then if you still think this policy makes sense, then maybe we should do it. Maybe you can talk to your advisor about it. But if the deal doesn't work at 4%, then this does not fit with your financial plan. Does that make sense?
Mm-hmm.
And so that's the conversation advisors need to have, is not, oh, wow, look at the illustration, look at how great this looks. It's, let's talk about your expectations of the future. Let's talk about what this product actually does. And it may be a fit, but if it isn't a fit at a 4% illustrated rate, then it's not a fit, right? It has to work at 4 or 3.5 or 4.5. It can't just work at 6, which, to your point earlier, a lot of what I see being marketed out there is very aggressively illustrated products. And that's the whole appeal, is the illustrated performance. And that's what an advisor, first thing they've got to do is tone that back.
Well, that's how the agents sell the product. They sell it off the illustration.
Yeah, that's right. That's right. And if you're a fee-only advisor, you've got to tone that down and make sure the product is a fit, regardless of the illustrated performance.
Now, we also might have some insurance agents that are listening to this. What would you say to them? What if they're saying, well, Bobby, I have to earn a living here, and I'm competing against financial advisors who can go say, the S&P does 15% year on year. Right. How can I compete, Bobby?
Yeah.
If I'm going to be illustrating IUL at 3.5%, I have a wife and a mortgage and kids, and how can they survive? And you doing this with honesty and integrity.
If, the industry is going to sell $3 billion of IUL, and if tomorrow all the maximum illustrated rates on these products went down to 4% and sales went down to $300 million, then we would know that people were buying IUL primarily for the illustration, not for the product itself. And that would be a huge problem. I don't think that would happen. I think IUL properly sold is a compelling value proposition. You're talking about a tax preferred asset. You're talking because of its death benefit protection. So there's clearly death benefit planning needs. There are tax planning considerations you can do in a life insurance policy. There's death benefit tax planning. Then there's the cash value growth and the stability of the growth and the sort of downside protection, upside potential story. None of these things have anything to do with the long-term performance of the product. The reality is every agent knows, literally every agent knows, that illustrations are not projections of future performance. Everybody knows that, but they all sell as if illustrations are projections of future performance. And that is where we have a problem. So what I'd say to guys, and I talk to people selling IUL all the time, and what I say is this: the less you can sell off of the illustration, and the more you can sell off of the death benefit, the tax benefits, and the cash value liquidity benefits and return profile benefits, the more sustainable, the more resilient your sales practices will be. And I think the more the product you're going to sell. Illustrations are a distraction. We got to sell what the product actually does and how it works. And that's the best way to sell IUL. And look, there's nothing to hide. The product is a good product. It does what it's supposed to do.
When it's properly designed.
When it's properly, when it's properly illustrated, it does what it's supposed to do. The problem is a lot of the sales are not being properly illustrated because regulators gave agents too much rope. They let them illustrate the rates too high. And that drives the narrative too much. And so even if those rates are achievable, even if clients actually get those rates, that shouldn't be the reason for the purchase. And I think, unfortunately, too often that is the reason for the purchase.
Do you think the agents who are selling it actually understand a lot of the technicalities that you just went over?
It depends on what agents you're talking about. There's definitely a crew of sophisticated agents who have sold this for years, and I think understand with a pretty high level of depth how this thing works, and they've bought into it. That's maybe 3% of the agents that sell this product. I think the other 97% of agents that sell this product are doing it because they see the illustrated performance, they see people making a lot of money selling it, they understand the basic positioning, which is, and none of these things that I'm about to say are true, but what they say is you can't lose money, you're going to perform better than equities, you're going to, this, super safe insurance company, long-term history of performance. None of these things are actually, maybe the insurance company piece, but the rest of it's not true. And so tax-free guaranteed income, I mean, I've heard that story for the IUL, and that's like factually incorrect. And so I think a lot of times when you look at IUL and why it's being sold, there's a narrative, and that narrative doesn't really match up to reality, but there is in a lot of cases, but there is a real narrative that really does do the product justice and that really can benefit clients. It just isn't nearly as sexy as some of this other stuff that we see on TikTok. Like that's the gap between the real benefits of the product and what's being shown out in the marketplace. And again, I think the vast majority of that comes back to illustrated performance and aggressively illustrated scenarios for clients that they get attracted to.
Clients don't understand it. Some advisors don't understand it. Some agents don't understand it. This is where the industry gets a bad name. And I just say that in the hopes that, myself included, all of us that are listening to this can strive for more transparency, more clarity, and a much stronger understanding of this and all other complex products, because this is where people lose faith in us.
Yeah. Well, and look, we've seen this movie before. So when you kind of stretch back and look over history, UL was popular in the 80s because it illustrated very aggressively. People thought they were buying a cheap product. What they didn't realize was if interest rates go down, their premiums must go up. That's not what the agents told them. That's not what the expectation was, but that is how the product actually works. So again, even with UL in the 80s, there's a difference between the marketing story and the illustration story and how the product actually works. Then we had VUL in the 90s. What was happening with that? Agents were illustrating ultra high rates, very cheap premiums. Clients didn't understand that if their equities didn't perform, the policy could be imperiled. And yet that's what happened. So those are two big black eyes for the industry. And then vanishing premium whole life, even before universal life, similar phenomenon. So we've always in life insurance had this problem of people talking about insurance as an investment, which they are legally not supposed to do, and positioning it as an investment and talking about it in ways that are completely inappropriate, based really on illustrated performance and the fact of what the product actually does. And actually, there's a great book about this called The Story of Life Insurance by Burton Hendrick, and he talks about the insurance industry in the US in the 1800s. And guess what? Same phenomenon was going on. There was this concept of a tontine whole life that illustrated the best returns. Everybody got into them. It turned into a huge scandal. And so we have had this constant issue in life insurance forever. And IUL is just the latest flavor of it, of a product that's being positioned and sold as an investment and as being touted as having XYZ performance. While it's a fundamentally sound product, it's just different than what's being positioned and marketed. And that gap is what causes black eyes for the industry. And like you said, I mean, we're setting ourselves up for this with IUL. And we've done it plenty of times in the past too. This is not the first time.
Okay. Bobby, what resources have you availed yourself of that can provide us with more knowledge and transparency as at the fee-only advisors or the advisors that are listening to this?
Yeah. Well, I'm not an agent, just to be clear. And so in a lot of ways, my resources are not the resources that an agent would use. I mean, I build insurance products with insurance companies. I write about all the issues we're talking about. And so...
Well, hold on a second. I'm sorry. You write about these issues.
Oh, yeah.
Is this blog able to be consumed by the public?
No, I charge for it. And it's a technical weekly newsletter on anything and everything going on in the life insurance space. And so it's written for high-end insurance professionals, high-end financial advisors who really want to understand what their clients are being sold. So I do have RAs that sign up. It's written for insurance company executives as they're thinking about developing products. It's written for brokerages. And so it's a technical deep dive. And look, I wish I could say there are a lot of other great resources out there to learn about all these issues. And the reality is nobody wants to write about life insurance, it seems, except for me. And so in terms of product issues, and so I'd say my newsletter, the Life Product Review, is the best known and best subscribed technical product industry resource covering what's actually happening in the marketplace. And outside of what I do, Cheryl Moore is a great resource on life insurance, especially on the annuity side. The Society of Actuaries has stuff on their website you can read, but again, very technical and geared towards the actuarial side. There are some other folks who I think there are some other bloggers. Chris Kirkpatrick, I think, has done a good job of talking about IUL. There's some pro IUL folks who I think actually do a good job there, but there are some that do it the right way, and I think do a good job of kind of trying to get rid of the misinformation. So I'd say look around, but if you want like real technical product oriented stuff, that's what my newsletter does. And again, it's the only option. It's the only thing out there that covers it the way that I do.
If you talk to a real high-end advisor who works with families that have a ton of wealth, like $50 million and above, family offices, et cetera, they're having their clients in $40,000 a year premium products.
Well, if not way more than that, yeah.
They have to grasp the high details that you're talking about. They have to be experts, or they have to work with somebody who is an agent and trust that that person is going to give them a fair deal, which is scary as heck.
That's what I see most of the time. I meet very, very few people. So my background is my dad's an agent, my granddad's an agent, and I started at a brokerage firm working exclusively with ultra high end. Let's put it this way, ultra high end agents and their clients. We had a unit that I worked in at this firm that only dealt with premiums above $250,000 a year, and we were slammed. I mean, I've seen cases with $5 million a year premiums, $3 million a year premiums. I see them on a pretty regular basis. Actually.
Right.
So now, but here's the thing that I think is really important, Sarah, that a lot of people don't get. The higher up you go in the market, the more trust matters. And what I see is a lot of family offices, a lot of RIAs, a lot of estate planning attorneys referring a trusted insurance advisor in, and the client saying, hey, I trust these advisors. These advisors certify this guy. I'm going to trust him too, and I'm going to do whatever he tells me. So there's an inverse relationship between the number of questions you typically get about a deal and the client's net worth. The lower the client's net worth, that's where I've found some very sophisticated buyers who really took their time to understand the product. And in fact, there's a guy I know who subscribes to my newsletter who bought a life insurance policy, went on a 2-year quest to understand it, and ended up becoming an agent and subscribing to my newsletter as a result of that. But he's a lower net worth guy. On the flip side, I've seen billionaires just sign the dotted line and do the deal, and they don't even ask any questions. And so what I'd say to your point is, like, these advisors who are at the top end working with larger clients, you must do your due diligence. You have to. Do not assume that even if this agent comes with great referrals, even if this agent has a long track record, even playing golf with the guy for years, do not assume that the insurance proposal he's putting in front of your client is the one that best fits that client. Do not make that. There are great agents out there, and there are agents out there who do stuff that I don't think is that great, and it is really hard to tell the difference until you actually look at what they're putting in front of clients. And that is where the rubber hits the road. And so, yeah, I completely agree with you. Folks in a position to advise high net worth clients, you don't need to become an expert, but you need to be conversant in life insurance, and you need to say, a truism here, right? If it looks too good to be true, not it probably is, it definitely is. And you have to look at that on these insurance proposals being shown to clients and screen that, because if you don't, what we're seeing right now is a lot of class action lawsuits, a lot of very nasty situations. I mean, class actions on one side, but a lot of individual lawsuits that are very nasty situations with very high net worth people who bought stuff they didn't understand and got hosed, and now they're looking for blood.
Well, but it's sad for them too. It's just a sad situation all around.
Yeah, it is. It's sad all around, but it's becoming increasingly common. There were certain types of deals that worked for the last 10 years and are not working right now. And those deals, that's where the problem comes in. And that's happening more often than people think.
Y'all, everyone listening, I also wanted to mention that Andy Panko is doing, it's called the IUL Experiment. Bobby, you've seen the website, and it's that Andy actually bought an IUL policy, and he's taking us with him on his journey. He has a whole website that goes over like all the documents that he got when he bought it. And it's absolutely
I
phenomenal.
love it. I love it. I think Andy's doing a great service to everyone by going through this himself. And my prediction is that in the long run, that IUL is going to look a lot like it if he bought a UL. I think he'll be happy with it, but it's not going to beat the stock market. So I think, yeah.
Well, but and I just mention it, and Andy's been on my podcast before, and we're colleagues, but I'm mentioning this because it's inspiring in the sense that he's really doing the work.
Yeah.
And I just would encourage everybody to follow that example.
Yeah, I agree. And look, that's what I do at my newsletter. I do the work. I read the filings. I read the illustrations. I talk to insurance company executives. Agents call me all the time. I mean, that you got to do the work. And, I don't have a real job. My job is just product. And so if you're an agent or you're an advisor, it's really hard for you to stay on top of all these issues. And so I think Andy's doing a good job of putting some stuff out there. But again, and then that's my goal with Life Product Review is my job is to look into all this stuff and then communicate it in a way that people can understand. That's what we do.
How do they find that publication?
Yeah, it's called the Life Product Review. You can just go to www.lifeproductreview.com.
There you
and
go.
There's 350 articles on on there. And so if you sign up, you get access to all of them. They're all about 3,000 words a pop. So carve out a couple of weeks and have at it.
Smoke, Bobby. Okay, awesome. Well, Bobby, thank you for all that you're doing. And like I said, I think we should all be on this transparency journey for the good of the clients, the industry, and to just have integrity with what we do. All of us, advisors, agents, marketing, vendors like me, everybody really that is involved with this in any way. So thank you so much for being here. And Bobby, how would you like people to contact you if they?
Go to my website. Like I said, lifeproductreview.com. That's the best way to find me. Thank you. And thank you for what you're doing too. I mean, we need more transparency and I appreciate what you're doing.
Well, you're very welcome. And I need to do a lot more. So I would love to just believe that we're just getting started with this.
I agree. Thanks, Sarah.
All right, everybody. So thanks, Bobby, again. And everybody, please rate, subscribe, and review this show. Just a reminder that nothing in this podcast can be interpreted as a product, insurance, or investment recommendation of any sort. Nothing in this podcast can be interpreted as legal or compliance advice. For any recommendations specific to your or your client's personal situations, please consult a consultant, advisor, or attorney.